Hey everyone, it's Daniel Snyder from Seeking Alpha. Thank you so much for hanging out with us today. We are going to dive into the conversation with Steven Bavaria. He is the investing group leader behind Inside the Income Factory, talking all about some sweet, sweet yield for you, hopefully, in the years to come. But before we dive into the conversation today, of course, as always, I have to get a quick legal disclaimer out of the way, so bear with me. Past performance is no guarantee of future results. Any views or opinions expressed in the webinar do not reflect those of Seeking Alpha as a whole. Seeking Alpha does not take account of your objectives or your financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Information provided by the investing group does not constitute investing advice. Investing group leaders are third-party authors that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Any content and tools on the platform are offered for information purposes only. And with that out of the way, I would love to go ahead and ask Steven to join us here today because we need to dive into the conversation about how the income factory works, because that is just like the sweet words we all want to hear. We want to set up the income, let it pile in, and not have to really worry about it, hopefully, right? Hopefully. But Steven, great to have you on the program today.
Hi, Daniel. Thank you. It's a pleasure to be here.
So we've got to kickstart from the beginning. Steven, let me ask you, there's people here, including myself as well. I want to know about your background. How did you get into the world of investing? How did you get to where you are today and creating the service here on Seeking Alpha?
Well, how much time do you have?
We've
No, a quickie. I grew up in Pennsylvania. I went to college in Washington at Georgetown, and I always wanted to go into international relations, the State Department. I was really interested in all of that. I was kind of a nerd. And then when I got through college, having majored in international economics, I found that the jobs, this was a long time ago, were mostly in banking and the private sector. They weren't really in the government or the foreign service, unless, for a few people got those. So I went into international banking and went up to Boston, to the old Bank of Boston, and got into credit and spent 17 years or so essentially on the credit side, trying to clean up other people's mistakes, collecting bad loans, this on the corporate side. So I ended up in Australia for a few years, Panama for a few years, being kind of a workout guy, and then came back to Boston and my career fizzled out, as a lot of banker careers did back in the late 80s, early 90s. So I was living in New York. I got a job at Citibank that lasted about 6 months, but it moved me down to New York, which was good. And I went back to school in my early 40s, studied journalism because I loved writing, and became a kind of cub reporter for a little magazine in New York that covered finance, Investment Dealer's Digest, and covered a lot of credit type issues, which was interesting. Now I was writing about it rather than doing it. And then, as lo and behold, I got a job offer from Standard and Poor's, who I'd written about a little bit, to come over there. And I was kind of in the right place at the right time as loans, which banks had always made loans and done their own credit work and kept the loans on their books to, until maturity. But they weren't an asset class that got sold to investors. And so they were beginning to become one. So loans all of a sudden were being sold to big pension funds and other investors where they were used to having credit ratings on the bonds they bought, and they weren't used to buying loans that didn't have any ratings. And so I thought, hey, this is something we should do. But it took a year and a half or so for me to convince S&P that we should do this, because it was a complicated thing. It seemed simple to me in some ways. I knew all about it. But you have to rate not only the company that's going to borrow the money, but you have to look at the structure of the deal, the collateral. So you end up with companies that might be single B companies, but you're structured a deal that is really well structured, and it becomes the equivalent of an investment grade credit. So that's what senior loans are, and that became an asset class. And then eventually I left Standard & Poor's in about 12 years ago. But by then I'd started writing for Seeking Alpha, and in my own investing, where I was now investing my IRA, I was kind of creating my own pension fund, or trying to, because I had an IRA and I was retiring, so I had to come up with my own, besides the pensions that I had from my companies I'd worked for and Social Security eventually, but that's not enough anymore to really live on. So I was investing and found that I could sleep better at night if I invested in high yielding loans and bonds and stuff that provided you a steady income. And you didn't have to worry about the ups and downs of the market so much because if you were aiming for a total return of 9 or 10%, which would be the, for the past century, the typical equity return on stocks has been anywhere from 8 to 9 to 10 or 11, somewhere in there. And if you can make that, your money is, you're going to double your money over time at that rate at every 7 years, double, redouble. So that's how you can kind of build for retirement if you start early enough. But I found that, with it, I learned more about this as I studied it more and everything. And I learned and realized that stocks, if you're trying to make that 9 or 10% return in stocks, you're getting a yield of about 1.5%. And you're counting on getting another 7 or 8% on average every year in capital gains. But you don't get it every year. You get a lot some years, not so much other years, none at all some years. So that can be kind of stressful. Even if you're an index investor and just not trying to pick winners, just trying to go with the whole market, you're still going to have that up and down. So that's what I realized that, hey, total return is total return. Math is math. So a 10% yield and 0% growth is the same total return as 10% growth and 0% yield or anything in between. And once I realized that, then the whole idea of explaining it clearly and the term income factory, I realized, hey, Ford Motor builds a plant. They don't worry about what the plant is worth or what they could sell the plant for a week or a month or a year later. They worry about how many cars and trucks and SUVs it produces. So I said, hey, let's think about our portfolios like that, and you have to be in this for the long term. If you're saving your money for a year or so and you're going to need the principal to send your kid to college or pay for a house or something, then this is not, you don't put your money in stocks or an income factory. You'd more likely put it in, lower yielding but more liquid assets. But if you're a long-term investor, you can take this approach, like your money's a factory, not worry so much about day to day, week to week, month to month, gyrations in the price, and just collect that steady 8, 9, 10% or more. I mean, it's going to go up and down as interest rates move and everything. But if you can collect 8, 9, 10% or on a regular basis for year after year after year, your money's going to double and redouble every 8 or 9 years. And that's going to be that's going to be more than a lot of people make who try to beat the markets, conventionally, because so many people will hedge, they'll go out of the market certain times, try to guess when it's going up and down. And they often, as many of them lose on that as gain, because, the market average wouldn't be an average if everybody could beat it, even though some people can. So I just have taken this approach. And the more I explain it to other people, a light bulb goes off. And now, when I started talking about this 10 years ago in Seeking Alpha, I got a lot of people saying, they didn't use the word heretic, but that's what they were thinking when you read what they were, you got to have growth. How can you have growth if you don't have growth stocks? That thing. And I would just explain. So that's how we got into the income factory. And now more and more people have told me, hey, it's a more predictable, steadier stream. You can do it in any number of ways. Real estate, anything that's gives you a high yield and gets most of its return through yield, and you're not dependent on the market giving it to you in capital gains, you can create an income factory. I give people ideas on my site of different model portfolios, some more aggressive, some less so, but there are any number of ways you can do it. It's the concept that's powerful and the name, which makes it easy to understand. So
Yeah,
that's my
Steve, let me,
story.
That's a lot. Let's jump in. We're going to double click deeper into all of this because there's some questions already
Okay,
coming in the chat, and
great.
we want to get to all these as well. But let's kick start from the top. So you realize that total return of 10% is what you were going to focus on, 8 to 10%, and you
Yeah.
focus on the yield aspect. And Raj over here in the chat says, where can you find 9 to 10% income debt instruments? I think this is an area of the market that not a lot of people might be aware of, especially on the credit side. Like we're always focused on the common equity or maybe even preferred shares. But
Mhm.
how can people find these investments that you're talking about?
Well, the primary asset classes that I focus on are credit assets. I mean, you can use high yielding stocks, like utilities and infrastructure shares, especially if you buy them in, say, closed-end funds, where you can often buy them at a little bit of a discount if you wait for the right entry points. Uh, you can get high yielding utilities and MLPs and things and earn 7%, 8%, 9%. Then in the high yield bond market and the senior loan market, you can get, again, and I like closed end funds because it's an easier way to hold. You can hold more complex illiquid assets in a closed end fund and not have to worry about runs on the fund so much. That's why ordinary mutual funds are less likely to be quite as aggressive in some of these areas. But you can get 8, 9, 10% in a whole host of high yield bond funds, senior loan funds, many of which have been around for years, are run by really responsible, experienced investment shops. And then another area, which is not really well known, but has a very good investment record, is the business development companies, which are called BDCs. And they're actually like little mini banks. And there are a couple of ETFs that actually are like funds of funds that own a whole bunch of BDCs that I use. Their tickers are one's an actively managed ETF called PBDC. It's run by it's Putnam BDC, and then there's another one, BIZD, which is the Van Eck BDC ETF, and it's been around for a long time. And I mean, the PBDC is newer. BIZD has been around for a long time and has a really good record. 9, 10% returns over or more, well, over the last 5 years. So anyway, those are the main asset classes. And then people will often say, well, shoot, aren't high yield bonds and these senior loans, aren't these really risky? They've heard of the term junk bond and that sort of thing. And most of these are non-investment grade credits. But what people don't realize is they're not nearly as risky as like the mid cap and small cap stock funds that most people own some of in their portfolios, if they're stock portfolios, because the bonds and loans issued by these companies are actually higher up on the balance sheet than the stock that a lot of people have been buying. So many people who say, oh, I'd never touch high yield bonds, if they look in their own portfolio, see a slew of high yield stocks, mid caps and small caps. So, and statistically, we know the default rates for these companies, and they might default 1 or 2% typically a year, on a portfolio basis, and they virtually always get back 50% or more principal. So if you have a 2, 3, 4% default rate, say a 4% default rate on a portfolio, and you get back 50%, you've lost 2% of your principal, and you're earning 7, 8, 9% in interest each year. So you can take the principal you've lost right out of your income, and it doesn't even touch your own capital. So these are much more predictable and stable than a stock portfolio would be. Imagine in a recession where you might have defaults of 6, 7% or 10 or 11% in the big recession we had about 17 years ago. But imagine, so if you had 10%, 12% defaults and lost 5 or 6% of your portfolio, you'd still be way ahead of how stock portfolios would be doing in those same periods. So yeah, nothing's without risk, but it's a much more predictable and stable risk with an income factory approach, I think, than with the typical ups and downs of the stock portfolio.
Hey, Steven, real quick, since you mentioned PBDC, I've held it up here on Seeking Alpha. We've been kind of like looking through the symbol page here and looking at the holdings. And as you mentioned, we do see all of the Blue Owl and Aries and Blackstone, as you mentioned. How do you
Mhm.
think about these expense ratios being at 13.94% for a fund like this?
Oh, I'm glad you mentioned that. That throws a lot of people off when they see that. The expenses of the fund itself are only like 0.4%, 0.5%. Under the accounting rules, if you're a fund of funds, and this apply, and for some reason it applies to BDCs in this particular way, they have to take all the expenses of the underlying uh, BDCs that they own and then add them up and make them part of their own expense ratio. But other mutual funds don't do this. And these are operating companies too that they own. I mean, a BDC is not just a fund; it's actually an operating company. So the operating expenses of Blue Owl and Blackstone and all of them, Ares, that's what they report as their expenses in the same way that every corporation has expenses paying for its office and its staff and everything else. So no, I'm glad, no, those aren't the real expenses of the fund. By buying that fund, you could go and buy all those individual companies yourself, those BDCs, but it only costs you about 0.4% more to have it done by professionals who then who run the fund.
All right, thanks for clarifying that. Just wanted to make sure because I know people see that and they sometimes freak out because in the world of ETFs, we're so used to seeing those
Yeah,
expense ratios get lower and lower. Let's talk
yeah.
about before we dive in. You gave me a couple tickers that we're going to run through here in a moment, but you set up. How do you think about like CLOs? That keeps coming up in the chat as well. Are you a big believer in CLOs? Do you think they fit in the portfolio? Is that something that you look to for yield?
Well, yeah, if for those who don't know what a CLO is, that stands for collateralized loan obligation. And they were started about 35 years ago. I remember writing a few articles as a reporter about some of the early ones, sort of explaining what they were. And there's also some confusion in the minds of a few people. We try to stop it all the time. See, there was something called a CDO that was made up of like really fraudulently underwritten home mortgage loans and home equity lines. They were done literally, like 20 years ago, and they were one of the big culprits in bringing down Lehman Brothers and some of these banks that went bust and causing the great crash of whenever it was, 2008 or so. They are not CLOs. CLOs are structures that hold loans what they're called broadly syndicated loans to major companies. They're all rated and well-known firms, and so they've been around since the late 80s and have a great record actually. And they not only you can buy the equity of them, which is like buying the equity of a bank because the equity is leveraged 10 to 1 in a CLO, the way it's leveraged about 10 to 1 by JP Morgan or Citibank or any other big bank. So if you buy the equity, you're buying a kind of leveraged bet on default rates not getting out of hand, and on the management of the CLO's ability to kind of manage around that as well. I am a believer in CLOs in that they've got a great record. Institutions have done brilliantly holding CLOs for the last 30 years. They've made it through all the Great Recession. They've made it through the COVID crisis, and done well. CLOs have only been owned by retail funds for about the last, well, one of them, OXLC, was started about 13 or 14 years ago, I think. No, yeah, about 11 years ago or so. And then a few others have joined since. So now there are half a dozen CLO funds and a couple of ETFs. Um, but they the jury is still out, let's put it that way, on how well they will do in the retail format. They're held mostly by closed-end funds, a few are ETFs. The problem is because closed-end funds, unlike banks, cannot cannot create an accrual to accrue for future loan loss, because you always have loan loss. Even healthy portfolios always have some losses. With CLOs, individual CLOs are kind of like annuities, and they wind down over 6, 7, 8 years. They pay out all of their cash flow to their owners, usually pension funds, but now including closed-end funds. They pay out all their cash flow to the owners, and then at the end of each CLO's life, when they kind of wind down, you kind of find out what their losses have been in terms of loan losses, credit defaults, loan losses. And it's always, the point is that they've always paid out to their shareholders, including the closed-end funds, more than they've actually earned, because you kind of have to give some of it back at the end when they don't get back all the money they originally invested. If they were a real bank, they would have created a reserve for this and hit each year's earnings a little bit so it never kind of piles up. But as a closed-end fund doesn't have the option to do that, closed-end funds are forced to pay out more distributions than they end up actually making. So you see some of these closed-end funds like OXLC and Eagle Point Credit, ECC, that are like big owners of CLO equity, and they'll end up paying out like 20% distributions, which looks terrific, and some people buy it just for that. But what they don't realize is then they kind of erode their price or their net asset value every year by a few percent or more, because of loan losses that are taken later in the life of some of the CLOs they own. So this is a lot of inside baseball that maybe everybody isn't as interested in. But as a result, I just say you have to be really careful with CLOs. I own some of the members of my group, my inside the income factory do, but it's not for the faint-hearted. You wouldn't want to put a lot of money into them. I think the jury is still out on how they're going to do over the longer term. I've got an experimental portfolio. Part of what I do with my group is, for certain things, we'll set up like what I call live models, and I'll create a piece of my own Fidelity account and buy a bunch of funds. I've got one that's just CLOs that we're following to see how it's going to do. I just started it a couple months ago, and the jury's still out on how it's actually going to do, compared to more dull and boring funds that pay lower yields but might do better in the long term.
Steven, I'd love to follow up real quick on this, because there are people in here that are interested about CLOs. And actually this morning, I just recorded an interview with the fund manager of JAAA for Jonas Henderson about the CLO space. And we were talking about how interest rates are going to affect CLOs. So with everything from a macro viewpoint for a second, if you will, because we have all the stuff from the administration and the Powell, and obviously this week we have the FOMC meeting as well. Are you expecting any interest rate changes in the future, and how that might affect the CLO space?
Yes, I expect interest rate changes in the future, but I'm not sure in what direction when. I mean, I think longer term, well, it depends a lot on inflation and, of course, our deficit. But yeah, we could see interest rates continue to go down, I guess, for a while, and then eventually they'll probably reverse. CLO equity, I'm not exactly sure. I mean, their loan spreads have been coming down a little bit. And since you've got your profit in a CLO is the leveraged, is the loan spreads leveraged 10 to 1. I mean, that's going to be a negative. Now, on the other hand, CLO debt and their leverage 10 to 1. So CLO debt is mostly floating rate debt. So that's also going to come down as rates come down. So it could actually be a kind of balanced impact, in terms of rates as far as the equity is concerned. CLO debt, which is also something that's a very interesting investment and has been a very good one over the years, where you tend to get paid more than the same rating would get if it were in a traditional bond or something like that, because CLOs are more complex. So there's kind of a complexity premium where, double B debt in a CLO will pay a higher premium, a higher rate coupon than double B debt in a traditional bond. On the other hand, it'll probably behave better. It'll probably have lower default. So double B debt has been a pretty good investment, but it's floating rate for the most part. And so we saw this recently with some funds that mostly own floating rate debt, that they actually they had to cut their distributions recently, not because their principal shrank at all, but because what they're receiving as income on it went down as interest rates dropped. So it's a mixed bag, honestly. Whatever the expert said, and I don't, I'd like to listen and find out what he said. I would listen to, he probably knows better than I do what it'll do, that's for sure.
All right. Yeah. If you want to check out that episode, it comes out later this week here on Seeking Alpha. It's under ETF Spotlight, and we talked to him. But let's go ahead and talk about the tickers that you sent me recently in this article that we wanted to talk about today, because I think people are here to get some more ideas from you. And then, of course, I also do want to mention everybody, I'm going to drop a link here in the chat. There is a free 14-day trial for Inside the Income Factory for watching this webinar. And as well, there's a sale going on as well, I should mention, for the next 2 weeks, where it's 10% off the yearly price, where you can get all of Steven's ideas, join the community that he has there. He is one of our best performing investing groups here on Seeking Alpha. His community is growing tremendously every year, which he can tell you all about later. But with that being said, I'll get out of the way here. Let's go ahead and dive into Barings Global Short Duration High Yield Fund.
Oh, well, this is a high yield fund that focuses on not taking much interest rate risk, which can be which is good if you think rates are coming down. What I like about it, one, it's owned, or it's sponsored by Barings, which is the name that Mass Mutual now uses. Barings was an old merchant bank that eventually it went bust some years ago, but its name was bought up by Mass Mutual. Mass Mutual is an insurance company, of course, and it's been doing private credit, what we used to call private placements when I wrote about them years ago, but it's been doing it for generations and is really good at it. So I like their funds. BGH is the one that is still at I think it's close to a discount. I haven't checked it today, but it's selling right around par, right around its net asset value. It's got two sibling funds that I couldn't put up when I made this list because they're actually too expensive now, but they're MPV, you ought to watch for these, and MCI. They're both Mass Mutual funds that were started years ago that are, between them, they're the number 1 and number 2 funds in the high yield closed-end fund category. And I would have had them on this list as well, but they've risen to premiums because they've done so great that, but they're also in the private credit sort of field, which is Barings Global Short Duration is partly in high yield bonds, partly in private credit. It's all run by the same credit platform. And all three of them are great funds. MPV and MCI are worth watching. If they ever come down close to net asset value, I'd snap them up.
All right, let's jump on over to Ares Dynamic Credit Allocation Fund.
Yeah, Ares Dynamic Credit Allocation is Sometimes it's listed as a senior loan fund, sometimes as a high yield bond fund by different entities. And that's one of its advantages. It's run by Ares, which is a terrific credit and investment platform. Lots of experience, but its mandate is to kind of go both ways. So it will invest in high yield bonds, it will invest in senior loans, and that's good because senior loans they're secured, they're top of the heap as far as protection, but they're also floating rate. So when rates are lower, uh, they're not going to earn as much, say, in income as a high yield bond fund, which has fixed rates. So they don't drop, but they also, if rates go above them, then the price can be hurt. But the beauty is that Ares Dynamic Credit, their management they're prepared to move either way. So they've got a portfolio that really is dynamic in that sense. They also buy some CLO equity and CLO debt, not enough to make it particularly dangerous, but enough to spice up their earnings, I think, and their yields. So I really like ARDC.
Yeah, I don't know if I would want to take that on personally. So it's nice having the smarter people out there do it for you.
Oh, absolutely. Yeah, that's why I only buy funds basically, because, I'm a portfolio manager and I'm a writer. I've got a lot of experience, but I don't claim to be an analyst. I look at other Seeking Alpha people who write these articles in depth about a lot of things as my analytical staff, frankly.
Don't we all? I mean, that was one of the big things that attracted me to Seeking Alpha was like, it's like having a hedge team, analyst team in your pocket at all
Yeah.
times. You get to read
Yep.
all the analysis, see the two different sides of the story right here. So we're looking at FSCO. This is FS Credit Opportunities Corp. We've got a couple buy ratings here as well as a couple sell ratings. So what can you tell us about FSCO?
Well, I just know that FS, the firm, I forget the names it actually stands for, but yeah, they've done they do some work. They're very close to KKR. In fact, one of the outfits, one of the funds I buy, it's another one called it's KIO, um, is a KKR income fund. But anyway, FS and KI and KKR, FSK, which is another FS creature. It's a BDC, which is very, very good, which is run by FS and KKR. But anyway, it's a really good group. And FSCO has a terrific, they've been on quite a good run. They're a senior loan fund. They've really been, they've got a very good record. And, once again, I buy them in part because of the people that run them. And like they made over the past year, they've been going great guns. They had a 27% return for the past year. Now that's on market price, 14% on their net asset value. The difference means that they've lost their discount and got, that they had a year ago because the market discovered them and really drove the price up. But they're really a solid outfit.
Some
The next one,
solid
yeah,
dividend growth as well. That's always attractive to see.
yep.
Let's jump over to Saba Capital Income and Opportunities Fund,
Oh
BR.
yeah. Yeah, Saba BRW happens to stand for Weinstein's the head of the firm, the head of Saba. He's got his initials on this fund, which means he's paying attention to it. They took over another fund that had a different name and symbol a few years ago, and they've really turned it around. And now they've been doing very, very well. But it's run by Saba, which is one of these activist firms that in the closed-end fund market, they will look for funds that are at big discounts where they think management has gotten kind of lazy about taking care of the shareholders, and they'll buy in a position and put pressure on the fund to try to do things to to decrease its discount and get its price up. Typically, like a tender offer at a higher price, things like that. So BRW I got into them a few years ago, and they weren't doing that well, but they've really turned it around since. I had a feeling that he wouldn't put his initials on this thing if he wasn't going to be, putting his own efforts into, uh, turning it around, and it has. Whether it's Weinstein himself who runs Saba, or his team, they've sure done a good job turning it around, and it's still, I think it's selling. Let's see, yeah, a week ago, or I haven't looked at it real close. I think it was selling at a 6% discount. I'm not sure what it currently is, but yeah, I like it a lot. I own all of these myself.
Yeah, so let's take a real quick second because we got two more. But before we dive in, I think there's some questions here about like, are these funds that you hold within an overall model portfolio? How do people think about incorporating these when they join inside the income factory? Any sort of bits of wisdom you can share there?
Yeah, well, I publish, I have a model portfolio called our core model, which is about 39 funds and BDCs. And I do a monthly update on that. And it's intended to be funds that, you know, that our members, mostly our members are mostly pretty much do-it-yourself investors. So most of them don't just take an entire fund, model and replicate it. They'll use it as candidates to, incorporate into their own investing. But I think I have some members who do take a more, a more set it and forget it approach. I have smaller models too for them. I have these, I call it KISS and DRIP. Keep it simple, Steven, and DRIP, dividend reinvestment. And I've got a couple of models with 10 or 14, and I'll actually make them live models where I'll go in, I'll take a separate account at Fidelity, buy them in, $3,000 each or whatever, and then just follow them and report on them and drip them so that there's no mistaking what the actual real life total return is over a period of time, because it's real money, my real money, not a whole lot, but I mean and it's just dripping away. So whatever its worth is compared to what it was a year ago or whatever, that's the actual total return. Nothing theoretical about it. So we have those smaller models for people who just want to get in gradually.
Yeah, we got a question here from Dennis. We'll jump into his question.
Sure.
When he says something, when you're talking about these funds and you're saying that something is selling at a discount, what does that mean exactly for these funds?
Oh, sure. With traditional mutual funds, you own 100 funds and they each own a stock. You want to know what the net asset value is of that fund or of your share. You add up all the market values of what the fund owns, divide it by the number of shares they have outstanding, and that's your exact net asset value. And if you want that money back, you go to the mutual fund and say, I want to redeem my shares, and they will pay you at the end of the day, what your actual net asset value is. With closed-end funds, it's the same thing in that the fund has, hundreds of different assets, different stocks or bonds or whatever they own, loans, and it prices them at the end of the day. Although some of them are less liquid and you can only price them once a week or once a month, then you kind of have to estimate. But they come up with an actual price that they think, if we liquidated our portfolio today, this is what we'd get for it. And then if you divide that by the amount of shares outstanding, that's the net asset value per share. However, closed-end funds are closed. So you cannot go to the fund company and buy the fund or redeem your shares. To buy the shares of a closed-end fund company, you buy them on the open market. So the shares are sold on the open market on stock exchanges. And then when you want to redeem your share, you sell it on the open market. So that means at any given time, you've got a posted net asset value of the company, of the shares, which is what they're really worth in terms of what they own. And then you've got a market price, which is what you can buy them or sell them for in the actual market. It's more, think of it as like an investment company. Every fund is kind of like a little mini investment company. If you set up an investment company and then you sold your equity in it to the marketplace might not value you at your par value or, at your net asset value. Just like any ordinary corporate out there, you can always find or you can look, I mean, they might publish it somewhere, the book value of the company, but usually the value of its stock is above or below what the actual book value of the company is. Well, it's the same with a closed-end fund. You're actually, you're buying into this fund, but you're paying a market price that may be above or below its actual net asset value. If it's below it, that's a discount. If it's above it, that's a premium. Buying at a discount means you've got more assets working for you than you actually had to pay for, which is great in a lot of ways. It also gives you a little cushion, if a stock's selling at a premium, I mean, if a fund is selling at a premium, it's more likely to have people say, hey, it's at a premium, I think, and I bought it lower. I bought it at a discount. Maybe I'll sell out and find another comparable fund that's at a discount. So there's a lot of sort of, I'd say, a certain amount of churning of portfolios where in the closed-end fund market, say you really like senior loans, but you got 3 or 4 funds that all do it well. You may buy into the ones that are at a discount, but if they rise and the other ones fall a bit, you might want to sell yours out and buy an equivalent one that's at a closer to a discount. So there's a fair amount of that goes on in the closed-end fund market too.
Yeah, thanks for clarifying that for them, Stephen. All right, I want to jump into these last 2 picks that you shared with me, starting off with the PIMCO Access Income Fund. What are we looking at here with the PAXS?
Well, that's a PIMCO. Yeah, PIMCO has a great record. They've got a bunch of closed-end funds and other funds as well. They have their own other mutual funds, but they have a number of closed-end funds, and they've got such a great record that a lot of them sell at premiums. But I try to look for the ones that sell closer to par. PAXS is one of their newer ones, but it's run by the same people who run all the other PIMCO funds. And has been selling right close to par, which is really good for a PIMCO fund. I've owned it for a while, and it's again, it's hard not to like an 11.8% yield. It's had a 12% average annual total return, something like that. It's only 3 years old, but since it was started 3 years ago, and it's got PIMCO behind it. So that's, it's not so much a loan fund or a bond fund. It's more of it operates as a lot of PIMCO funds do in the fixed income market and is opportunistic about what it's in. So it's probably spread out among a lot of different asset classes, all in the sort of general fixed income category.
Now, this fund also pays the dividends monthly, as some of the things we've been looking at. There was a question that came into the chat of comparing it to the REIT sector, because REITs also pay out monthly. Do you focus on REITs within your portfolios as well?
Yeah, we own some real estate funds that own REITs. I mean, REITs, I don't buy individual real estate companies, or, REITs are just a form of a real estate company, but I do definitely buy closed-end funds that own real estate funds. In fact, there's a fund run by Cohen and Steers that's called it's got RLTY, or it's the Cohen and Steers Real Estate Opportunity Fund. It's a fairly new one. I mean, in the last couple of years, but Cohen and Steers is a very well-respected manager of lots and lots of closed-end funds, and this is one of their real estate funds that that I own and have in our models. So if you're looking for, there are funds. If you go in and look up closed-end funds, you'll see, I think, 8 or 9 closed-end funds that that specialize in real estate. But it's a good sector. It's a good sector within the closed-end fund community.
All right, thanks for clarifying that. And let's wrap it up here before we get into some Q&A with a ticker symbol GHY.
Oh yeah, that's just, again, there are a whole lot of funds. That one's it's owned by PGIM. That stands for Prudential. The P in PGIM is Prudential. I think it's Prudential Global Investment Management. But Prudential, just like Mass Mutual, for years and years, insurance companies made, did corporate loans, corporate credit in the private placement market. That's what it was called. It was for deals that were done directly with insurance companies from major companies, so where they didn't go through investment banks. And so the insurance companies that did this got really good at it. And just in the last couple of years, private placements, as they used to be called, have sort of caught fire with the retail investing community, and they're calling it private credit, and other communities as well. The other institutional investors are big in it, but that when you hear about the private credit sort of boom that's going on, it's the old-fashioned private placement market that has been done for years, and PGIM is one of the outfits that does it. That's why I have a lot of faith, in their ability. So yeah, that's a high yield. It's a global high yield bond market. So it's looking not just within the US, but kind of around the world at the high yield bond market. And as you can see, it's had about an 11% average annual total return for the past 5 years, 9.2% yield. It's for all of these, belong in diversified portfolios. I wouldn't go out and bet the farm on any of these, no matter how good they might be, how solid they might be. But I feel I sleep really well at night having a very well diversified portfolio that has this kind of credit in it, has these kinds of funds populating it.
Yeah, this is an interesting way. I was just thinking about, as you mentioned, because this is the global high yield. I was looking through here, the Argentina, Colombia, an interesting way to play the international market, maybe minimize some of that risk, right?
Oh, for sure. Oh, diversification in all markets is critical. And it's why I don't go crazy worrying sometimes about specific issues. I mean, I pay attention to them and look at them and see who runs them and what their record is. But if you've got a lot of them in your portfolio, then none of them by themselves are gonna cripple you, even if they get into a little trouble.
Steven, yeah, sorry to cut you off there. I just want to make sure we start getting into some of these questions. There's been a lot of questions coming in on trying to just figure out how should the investor think about the tax implication of their portfolios. And obviously, we don't know everybody's scenario, but are there any key points that you may be able to point out to everybody around how these different funds and how taxes might fall into their lap?
Yeah. For credit funds, I use credit funds a lot because closed-end funds don't pay taxes. They pass through their cash flow, their earnings to their investors, who then are taxed accordingly. So when you buy a credit fund, the taxes are going to be on income which started out as interest income, which is not qualified for tax purposes. Interest income, as opposed to corporate dividends for the most part, are qualified income. So I have a taxable model portfolio that's mostly dividends from corporations. I mean, it's closed-end funds, but it's mostly closed-end funds that own companies that pay qualified dividends. In fact, some of them even bill themselves as tax-advantaged funds, where they say we're going to mostly pay either qualified income or even return of capital, which defers your payment until you actually sell the fund. Now, The tricky part, though, is that I also tell people there may be taxable investors. IRA, you know, IRAs are ideal vehicles, whether Roth IRAs or regular IRAs for deferring taxes. So you can buy anything you want in an IRA. You're not going to worry about taxes on the income. You're going to pay taxes 10, 20 years later, maybe, or five, depending how old you are and everything, when when you take the money out. But but these high yielding credit type funds are ideal in IRAs. But even people with taxable accounts, sometimes if you're in, say, a no tax or low tax state where you're only paying federal taxes, you might still run the arithmetic and find that, collecting 12% and paying taxes on it gives you more net income than paying 7 or 8% in and not paying taxes on it or paying lower rates on it.
Do you expect any special dividends out of these funds throughout the years, or do you mainly focus on just like the steady Eddie monthly dividends as they trickle
Yeah.
in? Check
Well, that's
that.
all I'm hoping. All I'm expecting is steady Eddie, and even steady Eddie can become unsteady Eddie at times because if you're in senior loan funds, uh, I mean, they're a great, I call them a through the cycle kind of investment, but sometimes you're going to make 11%, and sometimes you're going to make 8%, because rates go up and down. But it's still, if you're in an income factor where you're reinvesting it, for the long term, and you've got a whole diversified portfolio of funds where some of the rates are going up at times, some of the rates are coming down, some are increasing their dividends for other reasons. Some may have to lower them. You put them all together, if it's a solid group and you're making on average 9, 10%, 8, 9, 10% for 10, 20, 30 years, you're going to be happy about that. And you're not going to worry. You're not even going to remember certain years where the rates went down a bit and you reinvested at 8.5% versus other years where you reinvested at 11%. It's all going to be part of the mix.
All right, let's dive into some more of these. So you are the man that built the income factory. So there's a lot of different questions about different ways people are getting income in the markets these days. So two things here. One, people are wondering, how do you think about mortgage REITs? And then some other ones are here wondering, how do you think about the covered call funds that are now bringing in income
Oh,
by selling covered calls?
well, I'm not a great predictor of mortgage rates or interest rates generally. Um, I do say, when rates first went up a few years ago, and people said, "Oh my God, they're up so high," and then they were expecting them to come down. You know, 5 and 6% mortgage rates are not that unusual if you go back over the last, 40 or 50 years. My first mortgage that I got in 1980, I had just come back from overseas, bought a house up outside of Boston, and my mortgage was 15.25% because that was how they were killing inflation back then. And we were thrilled to death when our rates went down to like 9%, a few years, and we could reinvest. So you got to keep some perspective about this. I don't know. Would you put your money out at a fixed rate for 30 years for less than 5 or 6%, or even for 5 or 6%? I wouldn't. So I'm not sure. I'm not sure how low rates are going to get mortgage rates, but there are mortgage REITs that you can invest in, and there's some closed-end funds that do that. What are like Annaly they're not a closed-end fund, but that's kind of risky. From everything I can see, you don't get paid a lot more for taking that sort of interest rate risk than you do for just taking regular credit risk with the kind of stuff I buy.
So there was a great question here. I thought it was a great question because, we all spend our time trying to invest and figure out how we're going to get 8 to 10% yield, as we were talking about at the beginning of the webinar here today. And some people are here looking at the US Treasury market and looking at where the rates still are. And if they are anticipating rates in or out, that's up to them. But why not take a portion of the portfolio, lock it in treasuries, guarantee that, and then just focus on the additional percentage points that you need to get on top of that?
I think that makes a lot of sense. If that's your risk reward sort of comfort zone, then, by all means. It depends what your needs are. I mean, I think, I'm kind of comfortable with with senior loans and high yield bonds run by, not CLOs paying 20%. I mean, I buy some of those too. They're my sort of mad money, not mad money, but I mean, I fully expect that I could have concerns there depending on what happens, and I watch it closely. But I have no problem, say, having my entire investment portfolio in loans and bonds and BDCs and that sort of thing, because I don't expect those cash flows are going to, I don't expect default rates of more than, recession level, no matter what happens. I mean, if we thought we were going to have a Great Depression, I'll tell you, 5 years ago, when COVID was hitting and we weren't sure, our government hadn't kind of quite grappled with it and taken it as seriously as we later did, I wondered whether we were going to have a Great Depression. So, when the economy was starting to shut down, we didn't know what was happening, but I don't envision that now. And I realized then that I and many others were more afraid than we needed to be, but it depends on your own personal risk reward profile. Keeping a slug in treasuries, especially if you can make 4% or whatever you can now make, is, that's not a bad decision.
All right, let's ask you one more question here before we wrap things up, because we're getting to the top of the hour. I can't thank you enough for all of the knowledge and all of your time here today. But the question of, give me one second, I'm dropping in the chat one more time the link to your service. If everybody wants to get that 14-day trial, if you have more questions for Steven, you can reach out to him there. Obviously, follow his author profile on Seeking Alpha as well. But as we dive into this last question to wrap things up, do you have any thoughts or concerns about liquidity of these income generating vehicles that you're using within your portfolio?
The liquidity.
The ability to get in and out. For instance, if somebody
Yeah.
has, liquid funds versus non-liquid kind of assets.
Well, the whole essence of the income factory is that we're going to focus more on the cash flow. I'd suggest, I have a chapter 2 in my book, but it's also published on Seeking Alpha as a separate article, and I would recommend people dig it out and read it, or I can send you the link if you want to post it. But where I try to explain how, if you're confident you're going to get the income, and we're talking long term here, then if the income is going to be there, you're not that worried about how it's going to be priced over the long term, because markets tend to follow the income. Income doesn't follow the markets. If you look at John Burr Williams, who wrote about this back in the 30s and who's still the guru on, how do markets work? Markets on income producing properties, real estate, you name it, markets tend to price based on what's the discounted present value of the total stream of income that asset, whatever it is going to produce. And so if you really believe that, and you've got a long-term perspective, and you're invested in portfolios that are producing distributions at 8, 9, 10%, so you know that your cash stream is going to double and redouble again every 7, 8, 9 years, depending on your yield, then I don't worry much about illiquidity, because I think it would have to be an awfully irrational market that would not, where there wouldn't be buyers for my stream of, the assets providing my stream of payments years from now, if they're producing payments that are so much larger than what they currently are. Maybe that's too nerdy an answer, but if I'm not going to need the money for a long time, and I really just plan to live off of it until I'm gone, then I'm not all that worried about needing to sell it. Now, if I'm going to need it for something next year or in a couple of years, send my kids to college or whatever, then I'm going to put some, that one questioner said, I'm probably going to put some in treasuries and in other more liquid assets.
Steven, let's go ahead and wrap it up there. That was a brilliant response, by the way. I mean, it just goes into
I
the
don't know how brilliant it,
how
I think it was
it's
pretty
how you
nerdy
invest.
myself.
It lets us into how your brain works, right? And that's why we're all here today to get to know you better. Obviously, thank you so much for the hour you've given us today.
Sure.
Everyone can't
Thanks.
encourage you enough. Go check out Inside the Income Factory here on Seeking Alpha. Go talk to Steven and see his entire community he's been building over these last, what is it 10 years? 10 years? I
It's
mean,
been,
come on.
well, I started Inside the Income Factory 5 years ago. Yeah, it is I think people appreciate the chat room as much as the articles and models. I won't say as much, but there's a lot of interest because I try to tell people to think of it as like a bunch of neighbors sharing their investment ideas over the back fence, and I'm one of the neighbors, and I'm learning as much from my members as they are from each other and from me, I think, really.
That's amazing. That's why we love to have you and all of our other amazing investment group leaders here on Seeking
Great.
Alpha. But thank you again for your time. Everyone, thank you for joining us today. Really hope you found something insightful here for you. If you're watching the replay, thank you so much for watching the replay today. That link for Inside the Income Factory is below this video. 14-day free trial. Everybody check it out, and we'll see you here again in the next webinar. Take care.
Thank you.